welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. Let's talk about the December setup for ETFs. This is the #1 month for stock gains going back 50 years. You know that, I hope. And on the surface, the setup looks terrific. 60% of NYSE stocks are above their 200-day moving average. That's higher than normal. And the small cap Russell 2000, ticker IWM, also recently breaking out to a 52-week high. Joining us now, Andrew McOrmond, Managing Director of ETF Trading Solutions at WallachBeth Capital, ETF consultant Chris Hempstead, Deutsche Bank's former head of ETF sales, and Doug Yones. He's the head of exchange-traded projects here at the New York Stock Exchange. And Chris, like I said here, you can't think of a better setup going into December. Not only the strongest month of the year, but we've got healthcare leaders this quarter, banks leaders this quarter, and tech leaders this quarter. The three biggest sectors are leadership groups.
Hopefully you didn't just ice the kicker, but yeah, I think December is setting up as another month of inflows into equity funds, particularly, you mentioned healthcare. There's been some merger arb activity, which came out of nowhere, so that's really good to see. The market's very healthy right now for equity allocations. I think we're going to see that all month long in December.
And Andrew, does it bother you at all? The defensive sectors, the profit taking we've been seeing recently. Right. So REITs have underperformed, utilities have underperformed this quarter, consumer staples have underperformed.
I think it's just a flight to quality, and it's tax loss harvesting. You can get out of something, put it in something else. We're in a better, as you mentioned earlier, we're in a better Fed cycle, much better than last year. So I think that's a big difference.
Doug, fixed income, we're still seeing inflows. I've been wrong about this for 2 years, wondering why it's happening.
Like a lot of people.
You're on top of this. Why is this happening, and what do you think is going to happen in December?
Yeah, I mean, it's been fascinating on the cash flow. Net cash flow in ETFs this year, $271 billion, but 51% of that into fixed income ETFs. So we continue to see the asset gathering, and it's happening using the ETF Wrapper, but choosing fixed income across all investors.
Now, I attribute it to new users.
You do.
Insurance companies, large institutions, putting money into play. It's a dividend, they can trade it, it's easily put on the balance sheet.
And fixed income is a very broad asset group. I mean, there's a huge difference between, MUB, between municipals and high yield, for example.
You've got high yield, investment grade, treasuries, you've got prefers, you got muni bonds, and then then you branch that out internationally, and you've got emerging market debt, developed market debt.
But can you say something about? Can you slice and dice that a little finer for us? Other than just fixed income, still seeing inflows. What in fixed income?
I mean, high yield's been volatile, right? We've seen tremendous inflows and then also tremendous outflows throughout the year. But it's also in international. We've seen almost $8 billion this year in international fixed income come in. But the primary movers, I think, have been in the short term. I mean, we would expect that with the way everyone's been expecting an increase of rates. And so short-term fixed income ETFs continuing to gather assets. High yield, though, again, every time high yield on, it seems like people are choosing an ETF and not necessarily a mutual fund.
Yeah, high yield makes some sense to me. If you believe the U.S. economy is going to hold up fine, this is essentially a credit play, right? It's not an interest rate play. The companies that are taking out the high yield debt will hold on in a better economy. It's stock-like to a certain extent. I don't think it's a crazy idea if you believe the U.S. economy is certainly not going into a recession.
They're volatile, but I don't think as overall risky as they might have been a few years back.
And you also have to assess what your thoughts are on the shape of the yield curve. I mean, despite the fact that we've identified all the different areas where you can invest in fixed income or not invest, you also have to assess what your time horizon looks like. Are you playing the short end of the curve or the long end of the curve? And the structure of ETFs, I think you both would agree, has held up phenomenally well, with all of these inflows, and even the ones that have had outflows. And there's been quite a few big ETFs that have seen big outflows, while others have been the recipients.
It's been heartening to see if we get some kind of weird market activity, the ETF business is going to blow up for the last 7 years.
We're still hearing that.
And we had December 2018, the worst in decades ever for the overall market, and the ETF structure held up fine.
Yeah, we continue to see ETFs provide the exact thing they're supposed to provide. Immediate liquidity for those that want access to it, but for those that don't, they want to be a buy and hold long-term investor. The ETF Wrapper provides some extra efficiencies. They tend to be a little bit more tax efficient. They tend to have lower costs, so they're providing what they're supposed to be providing, liquidity.
and we've had strength in developed markets as well. So the three things that have motivated the markets this year, number one, of course, the Fed being neutral as opposed to last year, being raising rates. Yep. Number two, we've seen generally, let's call it a trade truce, at least so far. Right. Hard to characterize what that is, but trade truce. And finally, there has been a belief that the global economy is bottoming out a little bit. We had China very supportive manufacturing numbers. The U.S. missed today. That's why we're down. But when you look at this, I still see that bottoming story is very, very important. And we've seen recently some better numbers in Europe. We've seen better numbers in China. So if you look at Europe, IEFA, the Europe broad European, that's been stronger recently. Yep. We've seen some inflows there. We've seen inflows into Japan.
Yeah,
some of this, as you said, is the weaker yen. Andrew, you've been saying that.
And a weaker yen, right? Yeah. So a couple of years ago, everybody was talking about DXJ. And then the last few years, they're like, what happened to Wisdom Tree? And the people that know are always like, it's just a yen depreciation story. That's all it is. And if that happens, which is starting to happen now, institutions will put that money back into DXJ, which lists Wisdom Tree as a company, but that's not the point. The point is that will be a vehicle where money will go because it hedges the currency.
Yeah. But it helps exporters.
But I'm wondering if you're not being a little too cynical about this. The economic stability has been better recently, and I mean, the numbers just have been a little better. Yeah. I don't know if you call it a bottoming or what. I'm certainly not saying it's roaring, but it may be a little bit more than just a weak yen overall. That's
right. And with the money with the U.S. kind of in a really good spot, people say, okay, I'm going to take a little bit off here. Where's some room for growth?
Yeah. What I don't understand in the United States is value over growth. A category I've never liked, value, because it doesn't mean a lot to me, and it's hard to describe it. But this quarter, we've seen value outperforming growth, but value stocks, when you have Apple as a value stock,
Apple.
it completely contradicts what you think of a common sense of a growth stock. You think of Apple for sure, but it's not the way it's set up, the way the metrics are set up. Banks are value stocks, so JP Morgan's had a great run, Bank of America's had a great run, and then you had a couple of healthcare stocks like United Health. When these stocks are up, these are the biggest stocks out there, when they're up double digits in a quarter, I mean, value is going to outperform, but does it tell us anything? I don't know what it tells us.
For the short term, it does, but if you extend the chart over the long term, and then even the nearer short term, that's a 3-month chart. If you look at 3-year, 1 year, and 1 month, growth is over value, and I think what happens, Bob, is that people need to find alpha, and they're finding it over the longer term to find alpha in growth stocks than they are in value. There's a safety play with value. I get it. Certainly, back in December, there was that switch. I think we talked about it here on this show, but it hasn't maintained itself.
So when you start the year, that's a good point, Chris. When you start the year out, meaning January on, active managers are like, here we go. We got to win this year, and they're just not going to get that in value, so it just goes towards growth.
Yeah, I think growth makes perfect sense to me. In a modern, developed global economy, growth is hard to come by. Real growth is hard to come by. Year-over-year kind of growth like you saw in Amazon and Apple, even Microsoft. That's very, very hard to find. And it makes sense that people would pay up. Why are you paying so much money? Because there's not a lot of it around. So it's got a higher value when you don't have as many real true growth names out there.
Pay attention to what's right in front of us. Online retail numbers hit a record. People are shopping, people are spending, people are comfortable, contributing to this economy. I mean, who am I to say that it's all make believe? I mean, this is here to stay, I think.
Gold. I just want to end on this before we move on here. Is gold losing its luster a little bit? Remember, gold was 10 years ago was a hedge against inflation. What happened to that story? Oh, now it's protection against uncertain times. It's like anything you want it to be. You could project anything on the gold.
Since we made it to December, I think gold will just stay either where it is at, or even give a little bit back to the next 3 weeks. But then again, with Bitcoin, in my mind, gone as an investment, the alternative will be gold in the next year.
It's a store of wealth, and we're heading into a very volatile, what is probably expected to be a volatile geopolitical season. So gold, again, you can't take it off of the chart right now, even though it's had a little bit of a pullback. There's going to be people putting money back in.
And investors, they keep putting money in, right? I mean, we look at the year to date, there's over $9 billion went into commodity ETFs. The majority of that was in gold funds. So they do attract a certain level of assets. Again, is it for everyone, or is it for everyone to have at a large level in a portfolio? Probably not. But at some level, we've seen the numbers prove out.
But the Bitcoin crowd, going back to your point, has clearly lost faith this year. A good crowd of them. They're not piling into gold.
Maybe I'm old school. At blockchain, I buy. The Bitcoin came too early in my mind. I'm sure it'll be a story, but how much less do we talk about it on CNBC?
I'm totally with you on that.
Yeah.
Totally into blockchain.
Yeah.
Cryptocurrency ETF, I don't know if we necessarily need that kind of thing right now, but blockchain is going to change
News to
the
follow.
world. Non-transparent ETFs are getting very real. We have talked about this in the last few shows. Recently, the SEC approved active equity ETF models that would not be required to disclose portfolio holdings on a daily basis. Fidelity, T. Rowe Price, Natixis, among them. This would allow active ETF managers to move from a mutual fund to an ETF wrapper while allowing them to keep their strategies hidden from shareholders. How's hidden? Well, these so-called non-transparent ETFs would move the disclosure of portfolio holdings from a daily to a quarterly event. Doug, active management has seen outflows for years. Will it really do better under an ETF wrapper? I mean, just because if you're a crummy active manager in a mutual fund wrapper, you're still going to be a crummy active manager in an ETF wrapper.
A wrapper is not going to change performance. It can change tax efficiency. It can also change costs. So it's important to remember, a lot of times active management, because it's in an expensive wrapper, maybe it's charging 50 or 60 basis points of performance, is eaten up by the cost of the wrapper. We can take that away. We can put it in a more tax efficient vehicle. Now all of a sudden an active manager has a better shot at beating their index.
Now you've got a horse in this race. You're with Natixis, right? You've also filed along with this. Where are you going to be the first to market, or tell us, handicap this? What's going to happen in the next few weeks?
I think the New York Stock Exchange has a horse in every race, and what I mean by that is we're working with every one of the issuers of these models. Yes, in one case we are a co-applicant, but Presidium was the first mover here. We're working with Presidium. We're working on filings for them right now.
Your thoughts on this?
Look, all the structures that have been approved and the ones that are waiting for approval, I think they're going to get it. I think there's going to be a place for them. It's going to come down to the $8 trillion mutual fund industry who hasn't really put these strategies into an ETF wrapper. How do they sell it? How do they distribute it? Who are they marketing to? The market will absorb it. The market makers and liquidity providers that are on this floor and others will be able to support these products.
Who's first,
there'll be enough information.
Who's the first client?
First to market.
Is that going to be really important?
I think so. I think the product will be efficient. Like Chris said, Doug's put a ton of work into making sure that this is why it's taken so long. Do it right, don't do it wrong, right? But you have to have a client somewhere saying, let's move $100 million into this product.
See, I'm going to disagree with the first mover advantage here versus other ETFs, because the reality is in the active world, there are star managers. There are a lot of active shops that have done it right for year after year. They've beaten their index. They've done a great job. Why not offer the structure to them? Does it matter that they're the first to market? I don't think so. I think there's certain managers that people would love to see in an ETF wrapper.
So we all agree that this is good news for overall ETF assets under management. That as a result of this, we will see more assets move into the ETF space. Are we all agreeing on that?
It's a winner for the end investor, because if I love an active manager who's performing well and I can get that same performance,
150 basis points, and now they'll charge you 90 or whatever. What will be the difference?
I think that's going to be it. I think easily 50 to 75 basis points comes off of the overall fee, because that's the cost of the fee structure for a fund versus an ETF.
Well, there's another example of collapsing costs for the consumer overall. We've talked a lot about Schwab and Ameritrade and going to 0% commissions. Now you're getting best fund managers out there, those that are able to make this transition, cutting 50 basis points. That's not nothing.
And don't forget, your brokerage platform has now gone zero fee for ETFs. So now you'll be able to trade these ETFs without paying a commission.
So how are people going to make money in the ETF space?
As an issuer of ETFs, you're looking for the best possible product. And what I mean by that is way of investing that makes sense in a portfolio, and then wrap it in the most efficient way. And that's how those managers will continue to make money.
They won't have to sacrifice fees, Bob. Just because a few large managers have been able to cut fees to nearly zero does not mean that a successful active manager, one that you're familiar with, where you're going to put your money in, can't charge 30 or 40 or 50 basis points to manage that fund. If they're earning the alpha and they're earning the business, then
especially if we come out of a passive market. We've just been in a passive market. If we come out of that, the money will flock to active.
Yeah, I mean, it's not going to be a trading vehicle. These are going to be buy and hold investment vehicles in most cases. I don't see them becoming hedge vehicles like SPY. I think these are going to be vehicles that people are comfortable with.
And Doug, you're making an effort to sort of reduce some friction in ETF trading, I should say in redemptions and creations. You're about to launch ETF Hub. Now, this is a platform that you say will make it easier for the creation and redemption process to actually happen. This is a little kind of corner of the ETF market that we don't pay a lot of attention to. But is there friction now and differences in the way people create and redeem ETF?
There is. So for somebody who's looking to bring new shares to the market, the ETF exists, but let's say money's flowing in. It's a manual process. You've got to reach out to different parties. You've got to track the assets. You've got to watch them go through the system. The ICE ETF Hub that you mentioned, it's starting to go live. It's been live for about the last month. We're starting to bring more issuers onto it. It standardizes the platform. It's open source. It's a way to make a super efficient vehicle of the create redeem. And so now you can trade the ETF, but you can also create new shares of the ETF, and it's simple.
Chris, I wasn't aware that there was inefficiencies, frictions, whatever you think, but it makes some sense to me. But you're a guy who was involved in this. You were a big ETF trader for a long time.
We're 25 years in. We've gone from 0 to 4.5 or 4.3 trillion dollars in assets, and that would indicate there isn't friction. But to Doug's point, there is an operational process. It involves multiple custodial banks and different logins and things like that. So making it more efficient certainly isn't going to hurt the business at all. Especially, it's going to make it easier for newcomers to come to the market as ETF either liquidity providers or operational support kind of providers. Because there's not a whole lot of them out there. There's really only
many people think.
Yeah, there's only a
couple
handful of major firms that are doing this. So if something like the ICE Hub were to come to market and make it easier for competition, I think that helps everybody.
I would like to see the banks get back involved. 10-15 big banks get back involved in ETF business. That's good for everybody.
We're going to keep an eye on that. Of course, you'll keep us up to date on what's going on.
I will.
But thank you. Very interesting moments here. Now, for more on the NYSE's new ETF Hub, visit our website, etfedge.cnbc.com. And that does it for this week's ETF Edge. I'm Bob Pisani. Thanks to Andrew, Chris, Doug for joining us today. Thank you for watching. As always, you can find all of our latest videos right here, etfedge.cnbc.com. We'll see you next Monday, same time and the same place. Have a good week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.